What's up, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. My name is Alex. We're going to be going over BBIG, one of the hottest stocks in the market right now. A lot of people are anticipating a really nice squeeze from the stock. Lots and lots of people are watching it. Implied volatilities at sky high levels. And we're seeing a really nice run up for the stock. And it's definitely holding its ground at this $10, $11 price point. So if we see another red day, we're looking for a retest on the $10 support. A lot of people are buying up this stock. It's holding its ground at this $10 level, so we're seeing some really good things. Implied volatility is off the charts with BBIG. A lot of people are pouring their money into call options. And implied volatility, meaning the options contracts, are going to be pretty expensive. So if you want to get in, it's kind of risky. It's better just buy and hold shares if you want to play out this squeeze. So one of the hottest stocks, pretty cheap price stock still, $11 per share. We could potentially see the stock going to $20, $25, you name it. Just depends on how big the squeeze is going to be playing out, because this is short squeeze stock. A lot of the short interest is pretty high, and we're going to be seeing a potential gamma squeeze this week as well, mainly from this run up, and all the call options are probably going to be exercised. So if we take a look at the BBIG options summary, the call to put ratio is incredibly favorable towards the call side. A lot of premiums are being bought for the call options, as we can see here. And what this is going to allow us to do is have a nice gamma squeeze if these contracts expire in the money. Meaning we want as much of these contracts, these call option contracts, to be exercised, which is going to cause a nice gamma squeeze on this stock. And as we can see, the most dominant strikes are going to be the $10 strike, followed by the $11 strike, and then the $9 strike for September 17th, which is next week. So we're really looking forward to the stock maintaining its $10 to $11 price point by next week. And if it can manage to do that, we can see the stock go to sky high levels due to a nice gamma squeeze. And that in turn may trigger a short squeeze, because remember, this is a short squeeze stock, and all these short positions definitely don't want to hold on to the stock if it goes to, say, $50, $100. So if this price of the stock goes even further, the short positions are definitely going to want to cut their losses and cover the positions to prevent further potential loss. So we're really anticipating some big moves with the stock. I don't think it's too late to get in. Buying and holding shares, the best way to play this, because as we saw earlier, the premiums on call options are definitely going to be pretty inflated. They're pretty expensive, and as you can see, we had a nice green day, up 6% today, and 2% after hours. We take a look at the call options. Most of these contracts are down in the money, negative 50%, a lot of red on these contracts. That's because BBIG has a really high implied volatility, as we mentioned earlier, meaning that if BBIG doesn't make a significant move upwards, your call options, even though it's a bullish position, is going to lose money. So buying and holding shares is a great way, especially a lot safer, to play out this short squeeze. But if you want to buy stock at a cheaper price, you could always sell options. Selling cash gear puts is a great way to get paid to buy stock at a cheaper price. So say you're fine with buying shares at $10 each, you could go ahead and sell a $10 cash gear put. And remember, implied volatility is pretty high. It's very inflated for the call side, but it's also pretty inflated and expensive for the put side as well if you're buying puts. So we're going to be selling puts. And basically what this means is at expiration, September 17th, 1 week from now, if BBIG stays above $10, we're gonna collect $160 of premium in full as our profit. if it dips, it's been dipping below $10 at expiration, we're going to have to buy 100 shares at $10 each. But remember, we're collecting $160 of premium no matter what if we're holding it until expiration. So our break even for this contract, this position, is going to be $8.40. So that means you're going to be owning 100 shares at that price point, which is not that bad. Especially if you do believe in this stock, you do believe in the squeeze, and really are focused on this stock playing out. But of course, you could do some higher call or put options. If you think this stock will actually rise a significant amount by next week, say you think it'll be going to, I don't know, $15 per share next week, because remember, this is a very highly anticipated stock. A lot of money is flowing into it, and it has a high short interest. So you could sell an in the money cash secured put if you want to capitalize on some higher premiums. And your break even is going to be pretty good as well, $9.40 per share. This is going to be safer than outright buying 100 shares of the stock, where your break even is going to be roughly around $11. So you can sell an at the money, you can sell an in the money cash secured put, like a $15 strike, and you're going to be collecting $560 of premium. Break even $9.40, which means if BBIG stays below $15 per share at expiration, you had to buy 100 shares at $15 each, but we're collecting $560 of premium, so you're going to be owning 100 shares at $9.40 per share. So really nice break even right there, especially if you do believe in the squeeze and you're very bullish on the stock, and you're going to be capitalizing over time for throughout the next week on the time decay that's going to be eating at this premium. Because remember, if you're holding a short position, a sell put, you want the premium to decay as much as possible. And if you take a look at the theta decay, it's pretty high at 17.4, which means this contract is going to lose $17 of value every single day, even if the stock remains flat. So that's going to be a good strategy. But overall, buying and holding shares, best way to play the stock. Buying options, kind of risky. If you're looking for lottery tickets, then you can, of course, buy some far out of the money call options. If you only want to spend like $100 or so, you could buy, say, a $15 call option. We actually recommended this on Tuesday, and it was only $14 per contract. So I know a lot of people made a lot of money buying these call options right there. But right now, premiums are pretty high. Because this stock did make a huge move, implied volatility almost 400%. But the good news is there's a lot of open interest, a lot of volume, and the higher the stock goes, the higher the chance there's going to be a gamma squeeze. So that's about it for this video. If it helped in any way, please leave a like, comment down below what your thoughts are on BBIG, and of course subscribe if you're new to the channel. It helps out a lot. Thanks for watching.